This is the Curious Pundits podcast, hosted by Kevin and Emanuel. They explore bits of everything through thoughtful conversations, prioritizing curiosity over conclusions, and they thank you for joining them. Now, on to the podcast.
Hi, everyone, and welcome to yet another episode of the Curious Pundits podcast. It's been a while since we've recorded an episode. We were on a small vacation, but we'll surely catch up. My name is Emanuel, and I'm the co-host of the Curious Pundits podcast.
My name is Kevin, and I'm the other co-host.
And today is the first of many episodes that will fall under a different category. Maybe it'll be already on the website, will be a separate one, but it's still a Curious Pundits episode, and it's a rant that Kevin had on his list for a while. So I will basically be sitting quiet, take notes in my agenda from what is about to happen, and ask questions if I have any. That being said, passing along the virtual microphone to you, not before telling our audience just a little bit as a preview what this episode is all about. And as we said, it's the first of a series. So what this series implies, if you can give some more context.
The umbrella term is macroeconomics. So I've become a bit of a macroeconomics nerd over the past many years. And there's many very well-known stories about how economies work that, as near as I can tell, are just flat out not true. And the part I find kind of fascinating is that these stories are so well-known and so well accepted, but when you dig into it and take a look at how things work, it's like, that's not even true. Or we give that thing an incredible amount of importance, and it's not important. Like, we do this a lot of discussions about economics. And I want to encourage you to interrupt me as often as possible, because the biggest challenge I've discovered in learning how things actually work is unlearning what we know to be true that isn't true. That's the hard part. But once you've unlearned, then you can be open to learning how things actually work.
Quick question before I let you start. Do I need my tinfoil hat for this one, or I save it for later?
Some of this stuff may sound like it falls in the realm of conspiracy theory, but these are conspiracies that are being done out in the open, and they're easy to show to anybody who has an interest in learning this stuff. So it's not like a conspiracy that's done in back rooms. This is conspiracies that are done in the open.
If there's any conspiracy at all. So where do we start again?
We're going to start with the well-known narrative that central banks control the money supply. This is just generally accepted as a true statement. And when there's, quote unquote, too much money, people blame central bankers. Now, in order to explain what really goes on, we have to talk a little bit about what is money in a modern monetary economy. And I'm not talking about money as something that is a medium of exchange, has a store of value. All of that is true. But in a modern monetary economy, approximately 97% of all the money that we use are demand deposits in banks. So you take your debit card to the store and you buy something. The number in your demand deposit goes down, and the number in their demand deposit goes up by the same amount. So we're using demand deposits principally as money in modern monetary economies. So I actually want to back up a bit and talk about the idea of there being too much money. This is a concept that everybody understands. There's such a thing as too much money in an economy. Yeah?
Okay, so the first question is, does this apply to everyone around the world? Because you said take your debit card. Realistically, the debit card is not a reality for people in many places around the world, although significant progress have been made for the past, 10, 20 years. And maybe a definition of what is a central bank.
Boy, that's a good one. So the answer to the first question is no, it does not apply to everybody in the world, but it does apply to a significant percentage of the global population and probably most people in the world. There are people in the world who are unbanked, who do not use the services of banks. On a global scale, I don't know what percentage of people it is, but it does not apply to these people. It can only apply to people who use banks. So before we can talk about what a central bank is and why they exist, we need to talk a little bit about banking in general. Banking happened first, and central banking came along later to fill a need. But let me finish talking about what is money in a modern monetary economy. So you take your debit card to the gas station, the grocery store, wherever, or you write a check. A check is another way of taking money out of one demand deposit account and putting it in another. Or potentially you use a credit card, which puts an intermediate step in front of the change of demand deposits. So with a credit card, you literally take out a short-term loan from a bank, and then ideally, by the time the loan is due at the end of the billing period, you pay it back. And what you pay it back with is money from your demand deposit account. So in the meantime, the merchant receives money in their demand deposit account that the bank has loaned you. You owe that money to the bank, and at the end of the billing period, the money comes out of your demand deposit to pay off that loan. And that completes the transaction from one demand deposit account to another, right? So now that we've got the idea that the dominant form of money in a modern monetary economy is demand deposits, the next question is, what activities increase the aggregate level of demand deposits in the banking system, and what activities decrease it? So in a modern monetary economy, demand deposits is the most prevalent type of money. About 97% of all money are demand deposits. And from this point forward, I'm going to use the word deposits to mean demand deposits. And for the time being, we're going to pretend that time deposits are not a thing, just to simplify the explanation. So deposits are money, and things that are not deposits are not money. So central banks do not create deposits. Central banks create reserves. Reserves exist for the primary purpose of settling payments between banks. So let's say, I'm going to use Canadian banks, right? So let's say that I bank at Scotiabank and you bank at Toronto Dominion. No, to start, let's say that we both bank at Toronto Dominion. Okay. So I buy something from you for $100. My deposit account goes down by 100. Your deposit account goes up by 100. And because we both bank at the same bank, that payment clears inside that bank. Now let's say that we bank at different banks. You bank at Toronto Dominion, I bank at Scotiabank. Now that payment cannot clear inside the bank. There has to be a higher level bank, a clearinghouse, who clears that payment. And this is the primary use of reserves. So every time money goes into a deposit account at a bank, that bank's reserve account at the central bank goes up by the same amount. And every time a deposit account value goes down, that bank's reserve account at the central bank goes down by the same amount. So I pay you $100. My deposit account goes down by $100. My bank's reserves at the central bank go down by $100. Your bank's reserve at the central bank go up by $100, and your deposit account goes up by $100.
So essentially, keeping a ledger, the central bank keeps also a ledger that you can cross-reference with your internal, so to say, ledgers.
Yes, actually, it's hard to express the degree to which that basically is it. Money is entries on a ledger. Deposits are entries on a ledger. Reserves are entries on a ledger, right? And in the context of reserves being a part of interbank payment clearing, reserves are just an accounting entry that maintains a level of equity. So let's take a look at an individual bank. So to an individual bank, the loans that they've created are their assets, the deposits that they hold are their liabilities. So if we didn't, quote unquote, play this game with reserves, every time I paid you $100, my bank would lose $100 of liability with no change of assets, and therefore their equity would go up by $100. Your bank would have the opposite experience. They would have a deposit, which then was a liability, go up by $100 with no change in their assets, and their equity would decrease by $100. Well, we can't really do that to a bank. It's not the bank's fault that I took $100 and gave it to you, right? So reserves go up and down with deposits so that the level of equity is unchanged as we make payments to each other. So reserves are literally accounting entries that maintain bank equity during interbank payments.
What I was taught in economic school was simply debit and credit and the equality at the end of the reporting period, being month, being year, being whatever it is, right? And that's the
every couple of hours. Banks update their ledgers all the time.
Yeah, whenever you report a situation, you don't report it immediately in terms of personal or corporation finance. But yeah, for sure, debit and credit. That's
I focus in terms of thinking in terms of assets and liabilities, because the way the accounting profession uses the words debits and credits is completely non-intuitive. Maybe one day I'll bother to learn their nomenclature deeply, but every time I read like an accounting book and they're talking about debits or credits, in my mind I get it backwards because they do it in a way that is just not intuitive to me. But basically, assets and liabilities, that's the basics of it all. And every transaction that we talk about money moving from one deposit account to another, and that's kind of just linguistic convenience. What really happens is one account gets decremented and another account gets incremented. So money moves like a Star Trek transporter. It disappears from here, it appears over there, right? That's the way it moves. And it's just ledgers being updated.
Or debit and credit. That's the way
I
see it.
I'm probably going to get this wrong in here because it just confuses me every time. But when a deposit account goes down, like they call that being credited. And when a deposit account goes up, they call that being debited because they're looking at it from the bank's perspective. From the bank's perspective, their liabilities got debited or credited, and it just confuses me every time I try and look at it that way. Maybe I'll bother to learn that one day,
organization's perspective, organization, because you can do the same thing for your own corporation, right? You make a payment, as you said to me, so you're debited.
So your debit is my credit,
account.
Right? And vice versa. But that also carries over into the way that I've learned to look at it in terms of assets and liabilities. Because in terms of financial assets, by definition, every financial asset held by someone is a financial liability held by someone else, without exception. And this plays into the whole story of money. But let me get back to the concept of central banks control the money supply, right? So central banks create reserves. Central banks do not create deposits. If you go to the grocery store or the gas station, or you want to pay your rent or your mortgage with reserves, the answer is no. They don't take that. It's not money, right? So central banks do not create money. Now, there is an exception. There's a small handful of institutions on whose behalf central banks do create money. Now, you have to be a very special institution for them to do this for you. So an example is the United States Treasury, the Canadian Treasury, the English Exchequer. These people can accept reserves, and as soon as they accept them, they become a form of deposit that they can spend into the economy. But for the rest of us, no, that's not a thing, right? So central banks, with those exceptions, and there's like maybe a dozen of them in the United States, with those exceptions, central banks don't even create money. So if they don't even create money, how do they control the money supply? So then we get back to, okay, so in aggregate, things that increase the aggregate level of deposits in the banking system create money, and things that reduce the aggregate level of deposits in the banking system destroy money. So then, what increases the aggregate level of deposits in the banking system, and what decreases it? And the answer, when you peel back the layers, the answer is remarkably simple. So there are two things that increase the aggregate level of deposits in the banking system: federal government spending and bank lending. This is a difficult concept for people to grasp, but federal governments literally spend money into existence and tax money out of existence, and banks literally lend money into existence, and when they collect a principal payment on that debt, that destroys the money that was previously created. And that's basically it. So the money supply is determined by a combination of federal government spending, federal government taxes, bank lending, and payments on those bank loans. That's it. So the central bank is behind all that, knowing full well that when things go south, they're going to get blamed and they're going to be expected to clean it up. But the way the laws are set up, they have very limited tools with which to control the money supply. So this well-known story that central banks control the money supply is just flat out not true. Central banks don't even create money. So money is created by federal government spending, destroyed by federal government taxation, created by bank lending, and destroyed by payments on those bank loans. So federal governments and banks together create the money supply. And central banks are basically following them around, hoping they don't do anything stupid, knowing that when they do, because this is a regular recurrence, that they, the central bank, is going to be blamed and expected to clean it up somehow, in spite of the fact that they actually have very few tools available to them to actually control the money supply. So deposits are federal government spending and bank lending. So how much of those creates how much money? So it varies from time and place. The split is not always the same, but federal government spending tends to create about 3% to 10% of all the money in circulation, and bank lending tends to create 90% to 97% of all the money in circulation. So the dominant factor in what controls the money supply is bank lending. And if you take a look at the relationship between bank lending and federal government spending, boy, this is going to be a tough topic to segue into. So I'm going to just mention something now and then I'll clarify it later. So nothing has a stronger influence on the shape of an economy than how much bank lending occurs and what it occurs for. And broadly speaking, there's three things that we borrow money for. We borrow money to consume things, we borrow money to produce things, and we borrow money to purchase financial assets. Stock, bonds, real estate, that kind of stuff, right? And how much of what we do is the dominant feature of modern monetary economies.
So I wasn't living in Canada at the time, but I heard that during the 2008 financial crisis, Canada was not that affected as the US or any other country because the government was very generous on spending some money on development, building roads, houses, agriculture, industrial, the oil industry, some pipes, and whatever they did, they kind of spent a lot of money. People had jobs. I know actually a few Americans that moved to Canada, became Canadian in the meantime because they were out of job in the US and they would only find something good in Canada. Based on what you said, that's one of the ways money is created and also preventing some bad things to happen to people.
That actually segues very nicely into another rant of mine. And this is probably the biggest rant of all. And that's that the economic school of thought that dominates today is called Neoclassical economics. And Neoclassical economics, the people who practice it are rather proud of the fact that they have these mathematically rigorous models of how economies work. But their mathematically rigorous models don't include variables for money, banking, and credit. And literally nothing shapes how an economy operates more than credit. What credit is created for and how much credit is created for that. And this is the most important thing. Where do we, the people who borrow money, who make use of credit, get the money we need to make payments on those loans? That's the dominant feature of an economy. So if your mathematically rigorous models don't include variables for money and banking and credit, the odds are your models are not going to map to reality. So broadly speaking, there's three things that we in aggregate borrow money for. And it's the same three things that federal governments spend money on: consumption, production, and financial speculation, buying stock, bonds, and real estate. Right? So what tends to destabilize economies is too much financial speculation with borrowed money. So Canada has had a remarkably stable banking system in the 20th century. In fact, I'm super interested in the 19th century, Scotland had a remarkably stable banking system. And remarkably stable means that bank failures were really low. In the 20th century, Canada had and still has a remarkably stable banking system when measured by the same metric.
So one of the things that I tell other people is that banks so far, and I hope they'll be, are safe. I never heard about a Canadian bank going bust, whereas you've heard in the US, you've heard definitely happening in the fiscal paradises as Caymans and others. You've definitely heard going bust in Switzerland, which was, I don't know, the Eden of banking, safety. Cyprus, Europe, and US, it's common. Where I come from in Romania, nice anecdote. So they defraud the bank, and they actually at one point, because people keep going there, they removed the offices, but they decided to remove the building altogether, to demolish it. So definitely Canada has been and probably will be for the foreseeing future safe when it comes to financing, and especially financial institutions such as banks, but not just banks, right? There's wealth management companies, insurance, and so forth. But bank, specifically Canada, so far, number one, I think, in the world.
I'm not sure if it's number one, but Canadian banks are incredibly stable compared to banks in other nations. For example,
safety, instability, not necessarily cheap for sure.
No, not necessarily chasing the current shiny object. The way that banking systems and then economies get in trouble is they loan too much money for financial speculation. And that's great as long as the value of those financial assets keep increasing. Okay, so I'm going to talk now about a specific example of financial speculation with debt in a way that caused a financial catastrophe down the road. So it's the 1920s, and people can buy stocks on margin. And basically, I could buy $100,000 worth of stock with $10,000 because the broker would loan me $90,000. Now, the broker has a line of credit at a bank, and that money was created by a bank who made a loan to the broker. So I've agreed in the margin agreement that the broker will loan me no more than 90% of the value of the asset. The asset's worth $100,000. If the value of the asset increases to $120,000, I'm good because the $90,000 is less than 90% of the 120. But let's pretend, for sake of argument, that the value of the asset drops to $50,000. Based on a $50,000 valuation, I'm not entitled to a $90,000 loan. I'm only entitled to a $45,000 loan. So now I've got to make up the difference. I borrowed 90 grand. I'm only entitled to 45. So I've got to give them the difference in money in order to maintain my margin. And I'm using big numbers to illustrate the point. The same thing applies even if the value of the asset only dropped by 10 or 20%, right? And in many cases, the people who had to make these margin calls, they just didn't have the money. And that means that the broker will take the stock and sell it in order to recoup the money. And when this happens on a large scale, it creates what's called a doom loop, where everybody is unloading stock in order to get whatever money they can, but because sellers now outnumber buyers, the value of stock goes down and down, and the situation just gets worse and worse. And as this happens, as loans get paid off in some cases, or as loans get defaulted on, which put banks in negative equity, and then the banks get closed, like as that happens, money literally disappears from the economy. Oh, I forgot to mention in terms of something else that makes deposits go away. Before deposit insurance existed, a bank being closed would cause money to be destroyed. But now that we have deposit insurance, the amount of the deposit up to the insurance limit is no longer destroyed. It comes from the insurance fund. But back in the 1920s, that hadn't been invented yet, right? So there's less and less money in the economy, and that economic contraction is the trigger for a recession, or in that case, the Great Depression. Does that make sense? I know this is very technical very quickly, but you've got to understand it from these technical perspective, but it can be broken down fairly simply. So central banks do not control the money supply. Primarily commercial banks do. And the number one factor that creates financial instability is bank loans for financial assets, which later decline in value, causing the person who owns the assets and have the loan to be underwater and to have to take action to resolve that as best they can. And when that happens in a large scale in the economy, it's a crisis.
Perhaps we're going to tackle that in a future episode as well. So watch out for a part 2, a part 3, a part 4, and part 5, and a part...
It's going to be a few parts.
I don't know if forever. I do want to end up with an anecdote, if I may, for this episode. I've researched it because I didn't have some of the right numbers and names in mind, but I read it in the history magazine that during the Great Depression, farmers in Leroy, Saskatchewan, reopened the cheese factory, but could not be paid until the cheese was sold. So the factory issued cheese money, essentially backed by the cheese being produced. Local businesses accepted it like cash, essentially. Every coupon was eventually redeemed, and the system helped the community's economy moving forward, obviously during a rough time, right? So the farmers had milk, cheese, and so forth. Now, it worked up until a point. Once the cheese was sold, every coupon was redeemed, and all the farmers and merchants were paid eventually. And the co-op apparently even had a profit left to issue some dividends. The cheese money remained in use until 1936, when a large dairy company bought the factory and could pay farmers with regular cash. And I remember the detailed story being that the government can intervene. Obviously, you don't want as a government to have these kind of like local currencies as well. But I found it very interesting as an anecdote related to obviously what money is at the end of the day, right? What we exchange goods for, which is tied to today's topic. We borrow against them, against money, or against cheese coupons.
Fundamentally, money is someone's financial liability that we're just exchanging amongst ourselves as payment for services. And ordinarily, it's a bank deposit, right? But that little anecdote you told about this localized money, during the Depression, that happened all over. I'm going to talk about in the United States in particular, but there's a clause in the Constitution, and I'd have to look up the exact wording, but only the Treasury can issue money. But during the Depression, the amount of money in the economy just dried up. There wasn't enough money in the economy to fulfill all the transactions that people wanted to do. So there was this nod and a wink agreement with cities all over America, municipal scripts existed in Detroit, in Atlanta, in Los Angeles, like cities all over America. And it was like, okay, so here's the deal. I realized that there's not enough US dollars in existence for your economy to function properly. So here's the agreement. If you agree that you will not call it money, you'll call it municipal script, we, the federal government, will not outlaw it. Are we good? And this happened all over the country. In fact, I'm of the opinion that we should bring municipal script back. It's incredibly powerful. It's incredibly effective. It worked during the Depression. It could work anytime.
Topic to tackle in a future episode. Until then, my name is Emanuel.
My name is Kevin.
And together we host the Curious Pundits podcast. And this has been the first part of Kevin's rant about money, macroeconomics, and more specifically, things that we, the people, the majority, might think are true, which in fact are not. CuriousPundits.com. You'll find links, like, share, subscribe, and let us know if you agree, disagree, or we made a mistake or anything like that. Thank you so much. Up until the next episode.
Thank you for listening. We'll see you soon.
Thank you for listening to this episode. If you like the podcast, please like, subscribe, and tell others. Visit CuriousPundits.com to learn more, and stay tuned for the next episode.